people have said on some of my broadcasts, well, what if Powell wants to be the hero and pull Paul Volcker? Paul Volcker in the early 80s, he hiked rates up to unprecedented high level. We had the highest rates on record in the early 80s. Now, times were vastly different. He had the headroom to do that. And therefore, what happened? We did not get the mother of all crashes. We got a plain Jane bear market where the major averages corrected about a third, 33%, 35% off their peak. And everything was normalized. And that set the stage for a great bull market, the roaring 80s, fantastic decade for stocks, except for, 1987. This time around, we are at such onerous levels of debt. The yield curve is already flattening. Powell does not have room to hike. Maybe he'll get away with one rate hike. But we're not in 2017, rather 2018. Both of those years, actually, he was hiking Fed funds and discount rate got hiked several times. He had the room to do that, and markets did not crash. This time, I don't believe he's got that headroom at all. And anyway, the beauty of price volume action is I don't have to be right. All I have to know is what is the market telling me on a day-to-day basis. So once markets start to undergo major corrections, and it looks like we're undergoing one right now, that I'll know what to do. And I mean, I'm gonna be watching and waiting for Powell to indicate that, he's at the uncle point and he's got to now reverse his tapering decision or hiking decision.
So to take a step back, Chris, to give people a bit of context and color on it, like it seems like your focus right now is not so much on, whether or not there's institutional interest in Bitcoin or Ethereum or other crypto assets or other buyers. It's a mere macro perspective. And to take it even further back, as you were mentioning, what we've got is a really interesting situation where since back in the 1980s, again, since the Volcker period, we've been on a continuous decline in interest rates back down to those historic lows, which again makes the cost of credit excessively easy for institutions to get access to, for making it incredibly cheap to borrow capital. And outside of that as well, you've got quantitative easing. And we even talked about it back, I think it was in 2018, 2019, when I had you on the Data Dash podcast that we had. And we were talking about this idea how all of these central banks, the Federal Reserve, which prints money in the United States, the European Central Bank or ECB, the Bank of Japan, the Bank of England, all of them are printing money. And the crazy thing is that these are going onto the balance sheets of banks. And the problem is that it's not always going directly into loans or credit facilitation in the economy, but it's going to asset markets, and it can move anywhere it wants. And we've been seeing the US stock market being the biggest beneficiary of all this easy credit and capital, where Apple is now at a $3 trillion market cap. You've got tech stocks at bloated price to earnings ratios, to put that in simple terms, meaning that the stock value is so much higher per the amount of actual revenue, sales growth, profit making potential of the company. And now we're at this point where interest rates are at breakneck zero, basically. The Fed has already been printing historic amounts of money. And then finally, whereas it didn't have this issue the past couple of years because a lot of the money being created wasn't entering into the actual real economy, now because of the excessive printing that we've had, we are now seeing real inflation. The CPI manipulation, all the data metric things that you could do to kind of calm the nerves of everyday citizens, it's becoming apparent. There's supply shortages in the economy. You're seeing I think, for example, my friend, he likes Gatorade, right? He drinks it on a normal basis. And he was saying that an average pack of Gatorade was like going from $3.99 now to $8.99. So it's more than doubled in price. And I think these kind of telltale signs are pointing towards what you're saying, Chris, which is that right now in the economy, the Fed may be on its last opportunity, if not the last opportunity, to even try providing stimulus to the economy, coming back yet again to please the financial markets, which really are separate in a lot of ways from the actual physical everyday economy. The financial markets have been really propped up by this era of quantitative easing, and now we might be entering into an era of quantitative tightening. That's, if I'm getting it right, that's the general premise you're putting out, right?
Absolutely. I mean,